This is the third quarter update for the Amplify CWP Enhanced Dividend Income ETF, symbol DIVO, and the Amplify CWP International Enhanced Dividend Income ETF, symbol IDVO. Joining me for this conversation are Kevin Simpson and Tim Seymour. Let's jump right in. Kevin, when you look back on the third quarter, what stands out to you in the markets?
Well, it seems like we're fraught with headwinds, Jay. It's not just high interest rates, although I think that's the primary driver behind how equities will trade for the foreseeable future. But we still have drama in Washington. There was 217 votes. The Republicans gave us a speaker, but we have a very short window before the next potential government shutdown. Hopefully they'll be able to kick the can there. And obviously the horrific geopolitical events that are taking place in the Middle East are a massive concern and a potential headwind. And Tim will get into that also from the international side. But interest rates and earnings, I mean, that's what the story is going to be for the foreseeable future. When you have a 5% plus on the 10-year, it makes it very challenging for stocks. And earnings are coming in okay, but they're not coming in great. And I think what we needed was another blowout quarter of earnings. And I know we're still in the middle of them, but so far, okay just doesn't cut it.
Tim, really the same question to you. Like, what stood out to you in the third quarter? Where were there opportunities? Where were there concerns?
So internationally, the headlines are around both the dollar interest rate policy, central banks around the world. And clearly, if you look around the world, Japan is one of the places that I think you've had extraordinary price action in terms of the yen. You've had extraordinary potential changes in central bank policy in Japan, which has major ramifications, I think, for the U.S., but also the world. Third quarter characterized by higher rates around the world, central banks that are probably pausing, although in the case of Japan, where they might actually let go of this peg on their yield curve. And that would be very bullish, I think, ultimately for the international spectrum. I think it would be bullish for Japanese equities for sure, which in IDVO, there's already, essentially a thematic overweight. And I think as you look to the fourth quarter, the world of geopolitics is part of that. I think investing in a world where being sensitive to the China dynamic, both not so much the geopolitics, but even the dynamic around the economy, and investing and emphasizing places that are not as dependent on China, emphasizing markets that are also, as you might in the US in a period where there's volatility. One of the great things about investing internationally, where a lot of the investable market cap is, it's really focused on healthcare and industrials and banks and energy, which I think that story in the setup from the third quarter was very bullish. I think it gets better in the fourth quarter.
Kevin, let's dig into DIVO. When you look back in the third quarter, what changes did you make to the portfolio?
Well, specifically, we had Marathon Petroleum called away in the third quarter. It was a trade that worked out really well. It was a stock that almost looked, if you check out the chart, like an AI name. And but the higher price of oil obviously is helping the energy sector. We rotated from Marathon into ConocoPhillips and added to SLB, the old Schlumberger. We believe in the theme. We have had Chevron for over a decade, but now looking at the holdings, you've got Chevron, you've got ConocoPhillips and SLB. So we believe in the space, we believe in the cash flow model, and we believe in the dedication to shareholders that they're just going to continue to do everything they can to make sure that they're returning capital and not just wasting it on CapEx. The other thing that's happened more recently, Jay, in both DIVO and IDVO, is that we have seen a little bit of a pulse within the volatility, where we've gone, over a decade with the absence of volatility, except for a handful of occasions. Very recently, we've been able to write a number of covered calls in both strategies that years gone by, we would not have had that opportunity. So even though things look a little choppy out there, the covered call piece benefits and works best when we need it to most. So when we see a little bit higher vol, when we see the uncertainty within the equity markets, we dial up the call writing.
So Kevin, we're recording this in October of 2023. As you look at the rest of the fourth quarter and then into next year, what's caught your attention for that time frame?
Well, as we head into the year, I mean, it's possible that we could have a slight year-end rally, but the earnings, like I said, are coming in okay, not great. Interest rates are really high. There's problems abound. But if we think about how things are priced, it's based on a model. What are earnings and what multiple do you put on it? And even though the earnings haven't been awesome, it's not changing, I don't think, the forecasts, at least not yet, for 2024. So if you're at 240 or 250 on the S&P, depending upon what multiple you put on it, you're somewhere between 4,200 and 4,500. And if you think about it, that's where we've traded for the past 2 years. Stocks can't go higher when you put 500 plus basis points of yield into the world. So we're just in a period with DIVO, especially, we put on a belt, we put on suspenders, and we're going to try to tread water until such time that we can be more constructive on a broader equity story. Yeah, there's a handful of tech names that went up this year, but if you look under the surface since the end of 2021, nothing's really done anything. And it makes sense. But when we have rates done, when the Fed's done, which they probably are, or they're darn close to it, then you can get into the next phase, which is higher for longer. Well, what is higher for longer? It's higher for longer, not higher for tomorrow and not higher forever, but probably another year before they start cutting rates. But as Tim and you both know, the best thing about the stock market is it's not going to wait a year for the Fed to actually cut rates to benefit and to start pricing that in. Now, we may go through a recession before they cut rates. Maybe they have a soft landing, but either way, I think when we look out into the end of 2024, we can expect a much better landscape for stocks if you believe that lower rates benefit equities, and we sure do.
So, Tim, survey after survey tells us that U.S. investors are underallocated to the international markets. What's the investment case today for an allocation to the international markets?
It makes sense. And if you think about where the returns have been derived over the last 5 to 10 years, certainly in the last 5, U.S. tech, mega cap tech, high growth names in the U.S. have outperformed. There have been dynamics with the dollar. The dollar's been in a 12 to 13 year bull market. These are major headwinds to international investing. And I we're not going to, the strategy of IDVO isn't to make a tactical call anyway. It's to be the sister strategy to DIVO, which is all about reducing volatility, delivering more even streams of income with companies that are essentially seen as more defensive because they are actually growing their payout levels. So those dynamics internationally are alive and well, and they're that much more alive if you think about, as someone that's been investing internationally most of my career, what I do believe in are also these long tail and mean reversion kind of cycle dynamics. The underperformance of the international markets is something that I think after 10 years of underperformance of the MSCI global against the S&P is something that is changing. And I think it will change because I'm not going to tell you that Microsoft's not one of the most important companies in the world. And we recently had numbers from Microsoft that show that they're continuing to be a dominant player both here and abroad. But the allocation to international has been so underweight as almost as a function of the top 7 stocks being 30 to 35% of what people are investing in. That's going to change. It doesn't need to change tomorrow, just needs to change a little bit. This dollar as a bull market, the term I use sometimes is the dollar's a wrecking ball for investing internationally, and it has been. The dollar's not going to turn on a dime. Some of this is central bank differentials. Some of this are current account dynamics. But we started to see this last year where the dollar was weakening up, and it looks like we peaked in October. Then suddenly we had a 6 or 7% dollar rally, and maybe we're making an argument that some of that's topped out. The international argument is that you're just looking to find the companies that continue to both have exposure to global growth and those companies that also might benefit from some of these trends. And again, multinationals, when their home currency might be in the Netherlands or in the UK or in Japan, actually really benefit when the dollar maybe has made a peak. But that's not, we're not making a macro call on the dollar. I'm just explaining that for the last 10 years, it's been really tough to allocate because of passive investing going into mega cap tech and also dollar dynamics. The best thing about investing internationally is that if there is a little inflation, banks globally, which trade significantly cheaper to the US, are actually in a position to actually make money on the yield curve. The energy dynamics, where I think some of the big global integrated energy companies are actually even more sensitive and accretive, I should say, to the oil price. They break even at even lower levels and therefore are paying even higher dividends. And then there are places like healthcare where we know what's been going on with Eli Lilly and some of these big names that have been taking in a lot of market cap. there are global, whether it's a Novartis or Sanofi or a Novo. I mean, we're talking about companies that are positioned around the world that also, I think, are going to be defensive in a period where, if we are struggling with the macro and the earnings cycles over the next year, couple of years, they will be defensive. And I would just reiterate that the process at IDVO is intended to mirror the process at DIVO. It's to find these companies that you're not making a call on whether China's going to grow 5%. You're making a call on these companies executing.
So, Tim, one of the objectives of IDVO is to lower volatility if possible. What's the strategy used to implement that?
Again, it's pretty simple. It's covered calls that will also deliver both that additional yield component, but it almost requires that there is a very active process of assessing where companies, again, you don't buy necessarily a company and issue a covered call on the team at CWP. I mean, they've been doing this for a long time. The same strategy is there are times to take some of the momentum in a name and write that call and get even more benefit from selling that upside call because vol is actually a little bit higher. This tends to really bring down overall volatility. And when the cash flow cycle from each name is even higher on a relative basis, even that much more, it tends to bring it down. So on some level, the great thing is it's not a black box. It's pretty simple, even though the active stock picking, and just to be clear, I'm advising the strategy. I'm advising from a research perspective. Ultimately, Kevin and his team are the ones that are actually carrying out the portfolio management here. My view is to constantly be presenting ideas of where some of these companies have gone through an extraordinary cycle. And again, I would just emphasize what's going on both in energy, even in the resource space. I'm very bullish on gold. Some of the biggest gold miners do not sit in the United States. And those are companies that actually their fixed costs are in dollars, but essentially their revenues are in gold dollars. And as gold goes higher, those are the kinds of names that you could increase your weighting on, and you could actually be able to both actively and through the call writing process. I think you can mitigate risk.
So, Kevin, as an expert on writing covered calls and building out covered call strategies, I'm curious, are there any limitations to writing covered calls on the ADRs?
No, and Jay, the advantage for us is that we are using US-based options. We're not going out into foreign markets and dealing with currency risk and spreads and everything else that you can think of that would add to the uncertainty. We're using ADRs. We're trading everything here domestically. We use all the same option portals that we do for DIVO. It has been over a year now that we've run the ETF. It is super efficient. It is fun to trade covered calls on ADRs because they have a little bit higher vol in some cases, so you get better premiums. They have amazing dividends when you start to look at some of these international companies. It'll make your eyes get wide when you think of some of the potential cash flow. So if you believe in dividends and distributions and the power of compounding, which is how true wealth creation is done, you get that with DIVO domestically, you get it with IDVO on the international basis. And from the standpoint of a risk-adjusted total return and active management, it's an incredible space, and it's so much fun working with Tim. He blends right in with our team. And we're really looking forward to running this strategy for many, many years to come.
All right. Well, the last question is for both of you. And Kevin, I'll start with you. When you think about the regional conflicts that are flaring up across the globe, how does that impact your thought process around developing your domestic strategy?
Well, the truth is, Jay, the horrific events both in the Middle East and in the Ukraine have very little effect on our day-to-day equity portfolio in DIVO. We're looking at this as a human tragedy and something that we're always going to keep an eye on from a black swan event. But it's not something that's adjusting the portfolio for us. We look at a rules-based process, and whether the markets are up or down or sideways, we tend to try to do the same thing every single day because it works. What's going on in respect to all of the headwinds that we started the conversation with, they certainly keep me up at night, but they don't necessarily cause us to change. Because to Tim's point, we're a style box. We don't style drift. We have an equity portfolio, large cap, blue chips, dividend growth. And then we have the international version, which Tim will touch on. But it's our job to find good companies in any environment, whether it's a wonderful world or an insanely tragic and horrific situation.
as I always say from my global background, you can't invest in a bad neighborhood. So the practical reality is that you don't have to invest in certain regions if there is particular volatility. If you think about the market cap, that's really focused around investing in the Middle East and focused around investing in Eastern Europe, it's very small. Whether it's by weightings of the MSCI or wherever, especially in terms of liquidity. The local markets in the Middle East are very deep on a one-off basis, but ultimately there is, the other cliche is there's a bull market somewhere, and there are sectors that are outperforming, and obviously the world is interconnected, both with central banks, currencies, and geopolitical dynamics. And I think the world is not only, fortunately, on a human level, paying attention to these atrocities, but I think as we consider allocation, and again, this goes back to Kevin and team, they're ultimately carrying it out, but as a research provider and an advisor to the strategy, to me, it's about finding the places where there really are interesting opportunities. For example, Brazil. Brazil is a economy that at times is not only very tied into the fears around inflation and global interest rates. Brazil's arguably already made a fiscal adjustment. Brazil actually started cutting rates. But then drilling into the names, on some level, we're even, assuming the macro is okay and the neighborhood is okay, it's then about looking company by company. Petrobras is a company that I would have told you 10 years, no thanks. But the fact of the matter is, over the last couple of years, this is a company that has really been, I think, reoriented towards equity shareholders, by the way, of which the government owns the majority of. So, government, you're investing on board with a government that wants that big fat dividend. So the one-off, special divs that at least on a trailing basis make Petrobras a 20% div yield on a look back. I think it's more likely, an 8 to 10% going forward, and I think that's legitimate. But it's a case where this is a company that's operating more efficiently than they have. They're actually they've got an area that they call the pre-salt. It's a deep basin where it's very complicated to get to a certain point, but then after that, the economics are really accretive to the bottom line. They're having success, and they've got a project that's really coming online now that's going to, I think, lend support to the dividend profile. So again, it's Japan, where I don't love banks here globally right now, frankly. But if the Japanese central bank is no longer going to do their yield curve targeting, and there is some inflation, banks in Japan, which trade very cheap to global peers, look very interesting. So it's about finding the places to invest, not where we have to, but where we want to. And I think that's part of the strategy. Again, gold miners, GFI has been a position in the portfolio that really has had, on a look back, the numbers are impressive. We're not forecasting on the future. We're going to tell you that owning gold miners in this environment is a way we could drill into some themes. I really like gold here. I really like energy here. That's how we approach international.
Gentlemen, thank you so much for your time. To learn more about DIVO, visit DIVOETF.com or IDVO, simply IDVOETF.com.